Hi, I'm Andrew Wright, Principal of Professional Southport, and this is the Andrew Wright Property Podcast. I've built a multi-million dollar property portfolio, delivering a seven-figure annual rental income, and led my real estate team through thousands of sale and lease transactions. In each episode, I share real deals and strategies that will help you find, fund, and operate profitable property deals. The aim of this show is to provide education and build a community of like-minded investors who can collaborate, share insights, and help each other in each other's journeys. You can make excuses or you can make money, but you can't do both. So come and join us. Hello and welcome back to the Andrew Wright Property Podcast. If you consider yourself at a barbecue or a lunch and you're having a chat to the fella next to you and you say, "What do you do for a living?" If he told you he'd just built a high-rise tower in Surfers Paradise, it would probably make you pretty curious. Today's guest is a very good friend of mine, John Facer, who has helped shape the Gold Coast skyline. John's career began in the late 1960s working in Sydney as a construction manager for a company called Progressive Properties. In 1975, John was given a promotion to the Queensland Construction Manager. I'm going to rattle off some of the developments that John constructed in the 1970s, 80s and 90s, because if you live on the Gold Coast or you've visited the Gold Coast, you'll probably recognise the names of some of the buildings. Thornton Towers, 142 units over 17 stories. Beach Point, Aquarius, High Surf, the Peninsula building, which became the tallest building on the Gold Coast until 1992, Imperial Surf, Beachcomber, Beach Haven, 19th Avenue at Palm Beach, the Beach House at Coolangatta, Bayview Shores at Runaway Bay. John built a large project at Main Beach, 120 units at Currumbin Sands, and an iconic building known as Crown Towers, which many of you listeners will have heard. John not only built these projects, but in the early years with some of the high-rises, he helped assist preparing the feasibility studies that enabled and secured the bank funding. Today, John runs Ace Finance, a private lending company, backed by decades of construction and risk management experience. Welcome to the podcast, John. Great to see you.
Pleasure to be here.
Okay, John, so tell us about the early days when you came up to the Gold Coast and how you got into the business and what gave you the skill set to build these feasibility studies for these high-rise buildings.
Well, I was a construction manager for Progress and Properties, and they built a lot of three-storey walk-ups and high-rise around the Randwick and Coogee Bay area. And around 1975, they wanted to expand their development activities to the Gold Coast, as they saw that was the new growth area. So they previously built 35 stories of Condor. That was the company's first project up on the Gold Coast. And I was promoted to Queensland Construction Manager. And the first project we constructed was Thornton Tower, 16 stories. That sold very well. And then we went on to Beach Point, another 16 stories, 140 odd units. And we just continued building one building after the next. And so we've built quite a lot.
And in the early days, you were telling me before the podcast that the banks didn't actually even need a quantity surveyor's feasibility. Some of the banks would actually just look at your spreadsheets and calculations. Is that right?
Well, in the early days, the AGC funded it was a public company, Progress and Properties, and the feasibilities was done in-house. And I had my experience on site and in the administration was able to take the quantities off the plans and estimate, the construction cost using past projects as a guide and current trends, and the progressive projects would use that feasibility presented to the bank, or more so a finance company like AGC, and if they were satisfied, with the construction cost and the feasibility and the selling and the market price, that was they had enough confidence in the company, Progress and Properties, to approve the loan and provide the funding.
And did you always have a certain percentage of pre-sales on those buildings to get the bank's finance approval?
No, in the early days, the banks or the financier didn't require pre-sales. Currently, in the market, things have changed, but in the early days, the bank or the financier was comfortable, with the expertise and the ability of the crew or the construction team to deliver that project in a cost efficient and to manage it properly. And we didn't need pre-sales, no.
Okay.
They didn't require pre-sales.
Mm. Back in those early days in the 80s and 90s, there was a mob called Wright, Hunt, and they used to produce this research on property cycles, and they talk about these 7-year cycles. And you've been through a lot of cycles, and I want to talk about one of the crashes around that 1982 period. You were right in the middle of building, at the time, the highest building in Surfers Paradise in the Gold Coast, the Peninsula building. What happened? Can you just talk through briefly what happened when the prices crashed? And my understanding is this was before the building had been finished.
Well, it was an amazing situation, really, because in the early days when construction started, the market was very strong, and the agents were pre-selling the units off the plan, if you like, and it was very hard. The agents or people were finding it very hard to be able to sign a contract. They might have 3 or 4 contracts on the one unit. Someone would sign the contract and they would on-sell it to someone else, and they would on-sell it to someone else.
At a profit each time.
Hoping that each time pushing the price up. Then all of a sudden, I think it was June 82, the market just crashed, and the prices just dropped, unbelievably dropped, and everyone that had signed a contract, they didn't have the equity, or they didn't have the price. It was a lot less than what they signed the contract for, and they were all trying to escape or get out of the contract. And unfortunately, the developer had to try and protect themselves as much as possible, and they had to take legal action against the purchasers.
Right.
And they were very successful in forcing that legal action because the contracts were very tight.
Okay, great. So I guess it's only when you have a bad run in a property development that you appreciate building margins and contingencies into feasibility studies. I guess that probably made developers at that time a bit more conservative going forward. But another 7 or 8 years down the track, John, when the cycle turned again, you were building for Hudson Conway Bayview Shores, and you come across problems in the next cycle again in around the 1990s, is my understanding.
Now, Bayview Shores, that was for progressive projects.
Oh, was it?
Yes.
Okay, gotcha.
It wasn't Hudson Conway. The first project, progressive projects, that was their last project on the Gold Coast, Bayview Shores. Okay. And what happened there was the public company, which was Progress and Properties, which was bought out by Dainford. They had 2 major projects in Sydney. It was a hotel in Bondi and another hotel at Brighton Lee Sands. And those huge hotels, those sales fell through. which forced the company to go into liquidation. So, and Bayview Shores was a knock-on effect, I guess, because they had the one funder, the one AGC with the main funder, that was under their umbrella. So Bayview Shores, the funder or AGC took over the construction or finished the construction under their own construction management team.
Gotcha. Okay, so all the other projects that you did largely went to plan, but those two were just got caught up in this bad time of the cycle, I guess.
Yes, well, Peninsula was a different thing because it was more the market. It wasn't the cost of the building or the developer going broke. It was the market had changed, whereby the other project, Varsity Shores, not Varsity Shores, Bayview Shores, I'm sorry, that was a consequence of two other projects getting into financial difficulty because of the sales falling through in Sydney.
Okay, so you've just an amazing itinerary there of and timeline of building all these high rises, which has given you plenty of experience. And in your own capacity, you've done quite a few deals, which I'll just run through a small handful of them, John. But for our viewers, this is a property podcast, and I just want to talk to the audience about the fascinating ability of compounding to take effect over a number of years. And I looked on RP data just last week in preparation for today, and John purchased his residence in Admiralty Drive, Paradise Waters in 1978 for $55,000. Those numbers just to the viewers now might seem incredible, but neighbouring properties in that street are selling for $10 million, some of them. And I just want your advice to the viewers about long-term holding of property versus some of your neighbours have sold and maybe boasted about making a couple of $100,000 here tax-free or $1 million there. But you've held for, that's like nearly 50 years, John.
Just about, yeah. Well, I mean, I actually moved up to the Gold Coast in 1975, and I just got married, and we were looking to build a home and settle up here for the foreseeable future. And this block of land at Paradise Waters was $55,000, and I thought it was very expensive at the time. And I said to the seller, I said, "Oh, look," I said, "you're too expensive, and I'm looking for a discount." So he wouldn't give me a discount. He wouldn't budge. So I took the tablet, if you like, and paid the $55,000. And it was the best thing I ever did because I built a home there, and the actual time as the compounding and the value of the rise of products and cost of construction and wages has just been pushing the prices up. So really, the best thing I've found, or one of the best things I've found, once you buy a property, stay with it for the long term and not for the short term, because the longer you hold it, it's the best hedge you'll ever have against inflation. And that's proven itself time and time again. Hold on, hang on, and then if you need to buy another property, use that equity in that property to fund your next property, and so on and so forth. That's the best advice I could give anyone. If you've got a property, hold on to it, rent it out, borrow against that, and continue the cycle. And that way you protect yourself against inflation, and that'll be your quickest way to make money in the property market.
Mm. When you were in the construction business there for many years, I understand that you had the opportunity from time to time to actually buy units in those high rises you built. Did you buy many of them, and have you held any of those ones?
What I tried to do, wherever I could, was to buy a unit in each complex and hold it and then sell it. One particular unit I paid or bought was in Beach Point, 16 stories, 17 stories on the beachfront in Service Paradise. I paid $35,000 for that. Still own it today, and that would be in the order of maybe $900 or maybe $1 million today. So that just shows you, if you've got the patience and the time to have a long-term view of property. The cycle will go up and down, but you can be positive that it will always rise because of inflation, and the prices never ever. They might go down for a year or two, but they always come back a lot stronger. So that's my advice: buy the property, hold on, and keep it as long as you possibly can.
It's incredible. I mean, 35,000 to 900 and something. That's almost 30 times its value over that period of time, which is incredible.
Just for example, the site, the developer, Progress and Properties, paid $750,000 for the site for Beach Point. And now I believe that Meriton, at Harry Triggerbotham, has paid in the order of $50 to $60 million for a similar site, maybe 100 metres north of Beach Point. So it just shows you how the value or how the prices have increased, in the last, last 40, 50 years.
It's amazing. And down at Mermaid Beach, you've got a similar story there at 2 Oceanic Drive. You built 10 units there?
That's correct, yeah. 1980 I built 10 units, 10 two-bedroom units in Oceanic Drive. I think the land was about 50 or 60,000. Construction was a couple of hundred, so it's about 250,000 all up. And I've rented those units out for the last 40, 50 years. And I understand a similar unit sold the other day in the street for 940,000. So you can just see how much a property's gone up year by year. So
10 of them.
That's all pre-capital gains tax too.
So built before 1985, no capital gains. If you were to sell it now, potentially worth over $9 million with a cost base of 250.
In that order, yes.
And what about the rents there, John? Like over that long period of time, what were the initial rents per week?
The first rents were fairly low. I mean, by today's standards, 110, 120 a week. They're now, as I said, I still own the property, and they're paying average about $720, $725.
Yep.
So it's a remarkable increase.
Yeah, it is.
And it moves with inflation. As inflation moves, the rents move.
Absolutely.
So it's your best protection against inflation.
Okay, so you did a pretty large project, over 100 units, I understand, at the Italian Club, and got a bit of experience there. And then you went, you saw an opportunity on University Drive at Robina for another 120 villas. And what I like about this story is the land was purchased for $6 million from Delphin, but I like the creative way that you've actually financed this. So you didn't have the $6 million lying around. So you've found a mate to put in 50% deposit, and Suncorp's lent the other 50%. Can you talk us through the deal there?
Well, this was a remarkable deal. I mean, this sort of deal comes along maybe once in a lifetime, but this particular project, Delphin were having trouble selling this site because it was a split-level site and it had a main sewer going through it, but they wanted $6 million. I never had very much money at all, and my partner never had much money either, but he went to a private lender Steindl's to see if they could find a joint venture partner who would be interested in funding this project. And he, or Steindl's, the private, or the lawyer, introduced us to an investor who liked the area, he liked the university, he liked the design, he liked everything about the project. So we funded it by Suncorp Metway. They lent 50% of the value, so they lent $3 million, and this investor or joint venture partner, he lent another $3 million on an equity basis, not on an interest basis, which gave him a profit share of 50%, and my partner and I, we had a profit share of 25% each. The project was a great success. The prices, we got very good prices, and the final analysis, the project made over, the profit was 1.73, it's about 6.8 million, and everyone was happy. The private investor doubled his money, or more than doubled his money, and got his money back, and we were happy because my partner and I only invested, a couple $100,000 to do the preliminaries and to do the feasibility and put the documents together, for the project. So that was a very, very profitable exercise.
Yeah, it's just fascinating to me because I think most viewers of the podcast and most real estate investors in general, sometimes they come across a deal, they think, wow, this is so awesome, but, I can't do that. But what I like about that situation is you found a creative way. You were good at feasibility studies, you had the experience, John, and you found a way to get the finance done, whereas most people would have thought, oh, yeah, that's a great deal, but I can't do it. But you found a way to actually finance it.
Well, because of my background, because of my experience in the construction industry in Sydney and the Gold Coast, it gave Suncorp confidence that this project had good management or a proven track record. So that was a great asset in obtaining the funding, even though Suncorp Metway would only lend 50% of the land. They funded the construction on a cost to complete basis. So as we did the work, they funded the money for the construction, and sales went very well from day one, and so everything just fitted into place nicely. And I still own a unit there. We sold, my partner and I sold all the units. And I kept one, and I think that it was about $300,000. That was the selling price. That unit today would be worth over $1 million, and is in the letting pool, and is let out continuously to on a semester by semester basis, year in, year out, through the management. And it's been a very, very good hold and a good investment.
And you went a step further there. You had an agreement with your two other business partners that you would actually buy the management rights of that complex for $1,050,000, and you sold that 12 months later for $2.3 million. So that's what motivated you to go down that track, and how did you actually increase the value of that management rights business, John?
Well, originally, when we did the joint venture agreement, one of the partners had the opportunity to buy the management rights, from the group, from the joint venture partners, and I took up that opportunity, and the price was already set in the early days when we agreed. When we commenced the joint venture. So really we never had any numbers. We never knew how many people would be in the pool, what the percentage would be. We did some estimates, and we thought, well, we'd probably get, at least 50 or 60% students from the university. So it was a bit of an unknown thing. But once we completed the project and started to market the units through the university, they were that's where the main residents came from the uni.
This is Bond
and
Uni?
From Bond University.
Yep.
It was a deal. It's right on Lake Orr. It's a short walk to the uni. People don't need cars, and there's a great demand from the students. And once we got the place fully leased, we had over 100 units in the pool, and that made the multiple of about 5. I think it's 5 to 1 the multiple, and that's how they assess the value of the management rights, and that includes the unit, of course. So we sold it. The only reason I sold it was because I had my son-in-law managing it, and he wanted to seek other opportunities. So we sold it prematurely, sorry to say, and it's still, the rents are still going up, the prices are going up. So the current managers are very happy, and I wouldn't be sure what it's worth right now, but I'd say it'd be worth a lot more than $2 million.
Yeah, right. John, you had a few dabbles with some commercial property as well. You built a few industrial sheds and profited quite well. But I want to focus on a site that I find fascinating. You bought in Computer Road, Yatala, with a few friends of yours, and purchased for $4 million and sold within a year for $8 million, doubled the value. What changed in that short period of time to add that so much value to the site, and tell us the deal?
Well, that was another sort of stroke of luck, I guess. Sometimes these things come from nowhere. It was just a friend of mine. I spoke to a friend of his that said, there's a property up in Yatala. The owner is under a lot of pressure to sell it. He needs to sell it very, very quickly. And it's got a lot of development potential, and he's asking about $4 million for a quick sale. So I had a look at the property, and I thought that's a ideal position. There's a lot of factories around it. It looks like a growth area. So 5 of us, 5 friends, got together and said, okay, why don't we do a joint venture on this, which we did, and we put in about $500,000 each, and borrowed the rest from the bank. Then we went ahead. One of our partners was an engineer, civil engineer. So we went ahead and did a feasibility on the land to subdivide it into smaller lots. I think it was about 8 lots, and sell them off as factories for tilt panel factories were very popular, and it's still popular, strata titled, and they would be strata titled once developed, and that was another one of those projects that come along once in a lifetime. It sold very well, and the profit, the profit was about $4 million.
So that one there, it was really just getting a DA and selling them off, flicking it. You didn't go and build any of the sheds?
No, we didn't do any building. We probably could have made more money if we'd have done the building, but we just wanted to exit, get our money out, and move on and do something else. That was one of those projects that sort of don't come along every day. But we went through the exercise. We got the DA, did all the civil works. There was a few other conditions the council wanted. We complied with those. So it was just a very good project, very straightforward. It was level land. There wasn't any geotech problems or any drainage or flooding issues. It was just one of those projects that, didn't take long to actually do the subdivision, to do and get the approval and do the works, and they pretty well sold overnight, I guess. without too much marketing, and that's just one of those lucky projects that come along every once in a while.
Good on you, John. I want to talk about your transition. Like, you've had all this construction experience for decades, and you've all of a sudden decided to move into private money lending money to other investors to buy property. What motivated you to make that transition?
Well, when you're in the development business, in your own right, it's a continuous. You must keep buying, developing and selling, buying, developing and selling, and it's a continuous cycle. You can't just stop and start, when you feel like it. If the market's good or bad, to keep your team together, you need to keep the machine working. You've got good quality staff. You've got experienced construction managers. They need some certainty. They need some. They need to know where their future is. So you're more or less forced to keep developing on a continuous basis, despite how the market is. Now, that's a very risky way. It's very risky because if you get a downtime and your sales dry up, well, that's when you can get into financial difficulty. So, and mind you, it's quite profitable, but it can be spasmodic, whereby if the market really goes bad, well, then you've got serious problems. So I thought I'd be better off or better equipped to lend money to, boutique, smaller type developments, say 6 townhouses or maybe 12 townhouses, something in the order of $5 or $6 million, with a short building time, not too complicated, and lend money, fund those particular projects, and with my expertise to be able to ensure that the feasibility was the project had legs, so to speak, was viable and stacked up, and the developer would put in the hurt money, if you like, and I would maybe lend up to 70, maybe 75%, without the ongoing day-to-day management and the hands-on, and I didn't need to have a cast of thousands, if you like. I didn't need an architect. I didn't need to employ all these people. And if times got a little bit quiet and the market was a bit ordinary, well, I would just hold back from lending until the market turned. So it's a much more, I wouldn't say it's more profitable, but it's a lot less riskier on the proviso that, your LVR and you obviously deal with someone with a track record.
So you had a lot of confidence. Obviously, you're getting, in most cases, a first mortgage, LVR only up to 75%. And more importantly, with your background in construction, you knew that if shit hit the fan and something went wrong, you could probably take over the deal.
That's right. I always had the insurance that if something did go wrong, and one project that did go wrong, and the developer didn't do what he was supposed to do, and I won't go into the details, but it was poorly managed. So that enabled me to finish the project under my mortgagee conditions and take it to market and sell the project in a timely manner, because the problem with most developers, the funder, the bank or AGC, haven't got any experience at all in construction, and they hire a project management team who really, they have to be experts in the business as well, and that's a very expensive pathway to go down, where I wouldn't have any of those add-on expenses, that the banks would have to pay to engage someone to take on the role and responsibility of completing the project. So that was always an insurance to me, to be able to say, well, look, I've got the expertise to complete this project at a minimal cost, maintain the same contractors, and virtually continue to finish the project in a timely and effective manner. So that was always my peace of mind, if you like, if things did go, pear-shaped, so to speak. Yeah.
I just want to talk, John, also on that process, because there's a bit of a myth out there that private lenders are all hard money sharks, and if you fall into tough times, they'll come in and close you up and sell. But you told me just recently about one of your clients who borrowed some money building, and you could have gone and closed them up, but you extended, you've lent them more money. Can you tell us through?
Well, that particular project, it's all about, really, successful business is all about relationship. If you've got a good relationship, say, with your developer or your builder, and he is making a genuine effort to try, I mean, a lot of things can go wrong, even if it's a small project. If it's, say, I don't know, a dozen townhouses, a lot of things can go wrong that you don't, or developer doesn't plan for, like extremely bad weather, soil conditions. There's been a mistake with the geotech report. There's all sorts of things that can go wrong and can extend the construction time. Prices, we had a huge price rise during this particular project. Prices, the bricklayers were hard to get, trades were hard to get, and the construction prices go out of control. And this particular developer, needed more money. He needed more time. He was genuinely making an effort to complete the project. He'd put his own money into the project. So I, together with him, lent more money and helped him along the way and to finish the project, even though it was 6 or maybe 9 months later. And he finally finished the project, never made as much money as what he thought he would. He still made money, but we nursed the project through to the end, where a lot of banks or financiers, as soon as you miss a payment or as soon as you go into default, legal letters come out, and the whole thing becomes a disaster. Subbies stop working, the place sits there, there's arguments, and all this time the meter's running on the interest, and the project gets a bad name. The developer ends up losing his money, and maybe the funder loses money as well. So at all costs, you must try and use your best efforts to try and micromanage the developer so he doesn't lose his money, and just as important, you've protected your money and you're not trying to, recover your money by default interest, because that doesn't help the project, it doesn't help the developer, and you're looking for a long-term outcome. And next, also after that relationship, the same developer is doing another project. Now he knows who he's dealing with, and he knows that he's got a level of comfort and peace of mind that if things do get a little bit sort of, off the rails for whatever reason, that he can safely be at peace to know that I will try and definitely use my best endeavours to nurse the project through. And that does two things. It gives him a level of comfort and it gives me repeat business, whereas, that's what business is built on, relationships, and you can do another project, and you can build up a team or a small team of developers that you can rely on, and they can rely on you, and funding can be approved quite quickly. There's no long delay, months and months and months of spending money on application fees and then find out that, oh, I'm sorry, your project doesn't stack up. I like to be able to look at a project, analyse it quickly, check the market out, do some research, and try and have a quick yes or a quick no. That works for me. It also works for the developer, and I don't charge any fees up front. I'll speculate my time to look at the project, and that way, the developer's happy that he's getting a free service, if you like, and that way we get repeat business, and everyone's at the end of the day, everyone's got to make money. Developer's got to make money. I've got to make money, and if you can have a relationship where both parties win, that's the way to run a successful business.
So in summary there, for developers looking to borrow from Ace Finance or John's business there, so what you can expect is a free due diligence. You'll have a look at the deal and the feasibility study that you've put together. He'll give you a quick approval or a quick no, one or the other. His experience can come through and he can offer you some sort of project management advice based on his experience if required. And finally, what's great that we went through that last example is you're not going to go and sell them up straight away if you can work together with them and come to a solution.
So the thing is, I mean, a lot of developers, even though they have got a track record, I don't know, there may be 5 or 10 years, there's always something new. There's always something that they haven't come across before or a situation that they haven't been in. And I've been in many situations that most developers, well, a lot of developers wouldn't have been in, and I can offer advice, on the construction contract, like design and construct, the plumbing. It saves a lot of variation, design and construct, the electrical works, try and minimise your risk by having hard dollar, wherever you can have a hard dollar contract with your subcontractor, and try and spread the risk or make the subcontractor responsible for not only for the construction but for the design, and that minimises any variations that the developer might have. Some developers do their own construction, and some developers engage a builder. Just depends what sort of developer you are, but I cater for both. And what type of contract? There's different type of contracts. There's a lot of contracts that favour the client or favour the builder, or a lot of different contracts favour different people. And you've got to have the right contract, for your situation. So I can give advice there and say, well, if I were you, I would use a Property Council of Australia's contract opposed to a Master Builder's contract. Master Builder's contract would favour the builder. If you're a developer, you really want the contract to favour you, the principal.
Yep.
When I say favour, I mean, I just mean the person that does the paperwork generally has a contract that suits their requirements.
Yeah, absolutely.
The builder has a contract that suits his
sometimes
requirements.
it's not the builder, it's actually their lawyer trying to protect the builder.
That's right. Well, I'm not talking about a one-sided contract. It's got to be a fair and reasonable contract. No question about that. But there are conditions that the Master Builder's contract may have that may be a bit too tough, whereas if you're the principal, you might say, well, okay, if you want a variation, you must notify me, or extension of time, you must notify me every 2 weeks or something. But the Master Builder's contract might say a week. There might be just little things that in different contracts that lean towards the principal, or lean towards the developer, or lean towards the architect, who sometimes like to create something of a masterpiece, but don't worry about the cost.
Yeah.
So it's important to have the right contract when you're doing development.
Is it fair to say, John, too, as a private lender, that you do have the capacity and have in the past helped provide funding to people who may not qualify for a loan with a major bank? They may not have the serviceability, but if they've got some equity in their house or something like that, you'll actually look at the development proposal and just lend on the deal itself if they've got a bit of experience and provide finance where maybe a major bank wouldn't.
Well, the way I look at a deal, it's got to stand alone by itself. It's got the feasibility, the selling cost, the construction cost, the prices. It has to stack up on its own right. Now, if you go to a bank, the bank have a lot tougher conditions, a lot more due diligence. They might want pre-sales. They might, and they take a long time. It might take, 3 to 4 months. So the advantage of what I can offer is a quick response and cut out a lot of red tape. And whereby the bank may or may not approve the loan, if I believe that the project is viable and feasible, and there's enough equity in the project, well, I'll do the project where the bank, might, there might be 50% on the land, 50% LVR. Well, if I take on board the location, the area, I might lend 60 or maybe 65%. So there's that extra leeway which gives the developer a bit more wriggle room, if you like, to make the project work. So that sort of thing is the advantage of going to a private lender.
Yep.
Sure, the banks will be cheaper, but a lot harder to get funding out of.
Okay. And because you're mainly lending on the smaller developments and not high-rise towers, most of your loans initially are for a 12-month period and the interest is capitalised till the end of the project. Is that right?
Well, there's various ways you can do it. There's interest up front. If I can, there's different scenarios, but I can lend the interest up front for the period. They might use their own money for the first 3 months, so I might lend money for 9 months. And we might, I'll lend them the interest for the 9 months, so they haven't got a cash flow issue with the interest. They know the money's there. The money's paid on fortnightly payments or progressive payments. They know the money's there. And then when they sell, they pay the interest out. Or the other way that it can be done, it can be the loan can be approved, and say with a line fee of 1% or 2% of the actual amount required, and interest only paid on the money that's drawn down. That's probably a cheaper way to go. However, a lot of people prefer to have that interest there, all paid. They don't have to worry about the money's guaranteed. It's in a trust account, and there's no chance of the funder running short of money and say, I promised to lend you $6 million, but something's gone wrong. I've only got $4 million. I haven't got enough money to fund the project.
Yep.
Even though something's happened externally and caused you not to have those funds, where if someone pays the interest up front, that money's locked into a trust account and there's guaranteed that money will be there come rain, hail or shine to complete the project. So that's an option that can be discussed at the time, depending on the borrower's requirements.
Sure. Okay, so you're open for business. There's money in the kitty there to be lent out for the right deal. So if you're a property developer and you're wanting to get in touch with John, reach out to me through our website or my phone or my email, and I'll introduce you to John and see if he can assist with you. So private money lending is something that most developers probably need to look at. Given, the last few bank loans I've got, let me tell you, it took more than 3 months to get the approvals, and these were not for developments; they were just for straight out purchases with existing leases. So, getting a quick approval and benefiting from John's experience, not just his capital, is perhaps something that the viewers might want to consider down the track. John, I appreciate your time very much, and again, I'd like to thank you.
I've just got one more thing. With the project, I've got a pretty good feeling with my experience whether it's going to fly or not. Just through been doing a lot of projects myself, so I can generally assess a project pretty well. If I think it's it stacks up and it flies, well, I'm very keen to do the business. Whereas banks don't really have that expertise, and it's more on the numbers, etc., etc. So, and I can offer advice too, how I would approach a project, what I would do and what I wouldn't do, and I can advise against different pitfalls that that a lot of developers strike, but generally when it's too late.
Fantastic, John. Appreciate your time today coming into the podcast very much. You've been a good friend of mine. You've helped me out in various different areas, and I'm really grateful that you were prepared to come and talk on the podcast.
No, it's been my pleasure. Thank you.
Thanks, John. Okay, viewers, well, if you like that podcast and you know any developers, why don't you press the like button and forward this podcast on to your mates, and hopefully some of them might be able to benefit from John's experience. Thank you very much, and look forward to seeing you on the next podcast. Bye for now. Thanks for listening to the Andrew Wright Property Podcast. This is all about building a community of like-minded investors who can share real-life stories, experiences, and collaborate with a view to helping each other. Join us. Get in touch through the link in the show notes. I look forward to you joining me on the next episode.